Here's something you probably won't hear from most property gurus. Owning 9 high cash flow residential properties didn't give me the financial freedom I thought it would. In fact, when interest rates rose, my so-called freedom actually got cut in half. So I sold most of the residential properties and went all in on commercial property. I know it sounds insane, right? But that single move took me from $50,000 passive income to $250,000 in passive income. And I did need to become a full-time developer, gamble on capital growth, or sacrifice my lifestyle to get there. So let me show you exactly how I did it. When I first got into property, I followed the same advice that gets recycled across every podcast, forum, and barbecue chat. Buy residential, hold it, get the capital growth, and over time, you'll be set. So I did exactly that. I built up my portfolio to 9 residential properties that, on paper, looked pretty impressive. They were high yielding, and for a while, I was bringing in around $50,000 in passive income. I genuinely thought I was on the way to financial freedom. But here's what no one tells you. That kind of freedom is fragile. As soon as interest rates began to rise, that 50K didn't look so healthy anymore. The same properties that once felt like assets started to feel like liabilities. My passive income became anything but, eaten away by repayments, maintenance, issues, and the increasing pressure to maintain a growing, scattered portfolio. That was my wake-up call. It wasn't just about numbers not stacking up. It was that I started questioning the game I was playing altogether. Was I actually getting closer to the life I wanted, or just collecting properties for the sake of it like toys? That question led me to make a decision that would completely shift my approach. Once I realized that residential wasn't getting me the results I wanted, I took a step back and asked myself a more honest question. What kind of investing would allow me to live the life I actually want, not just build a portfolio for the sake of appearances? That's when I started seriously looking into commercial property. And almost immediately, the contrast was impossible to ignore. Commercial property offered triple the cash flow for the same level of capital. It wasn't just high yield, it was structurally different. Long leases, tenants who cover most of the outgoings, and fewer day-to-day headaches. The more I looked into it, the more obvious it became that this was the path that aligned with my goals. Not just financially, but personally. So, I sold off the majority of my residential properties and went all in on commercial. That one pivot took me from around 50K passive income to 250K passive income. Let me show you. So let's have a look at the actual commercial property that I purchased with selling my residential portfolio. The thing for me is, even though I'm a commercial buyer's agent, I'm not doing this for a huge value add or anything like that. This is purely for security to get the cash flow and the passive income so I can live the life I want. This deal actually has nothing special about it. I actually sent it to a couple clients who said no to it because on paper, it just ticked the boxes. There was nothing unicorn or special about it. However, that's what I liked about it. So let's go run through. This property is an entire shopping center for $3.175 million. That I bought in Regent's Park, which is in the local government area. What I liked about this property is, you can see here, it's a huge land portion and it's got 8 different tenants. So there's the typical, it's got a food works, it's got a hairdresser, it's got a bakery, it's got a fish and chip shop, it's got all the usual things on it. However, there's no other shopping center within a 1.5 kilometer radius. So that's actually about 5 square kilometers of land where there's no other retail shops. The other good thing I like is it's next to a major state school with quite a large amount of students and next to a major kindergarten. So during the 8 a.m. to the 3 p.m. is very busy kind of road traffic times. The other point I want to note is houses in this area generally sell between 800 and 950,000. So as a long-term kind of play, 3.175 million is actually not a bad kind of site, because if I divide this site up into say 500 square meter lots or even 400 square meter lots, I actually get 7 to 9 lots I could actually sell this off at. Also got development potential where I could build residential on top, or build a little, if they change the zoning to medium density, I could build townhouses or an apartment complex. But that's not why I bought it. I bought it because it's a good sized lot next to a major school, no competition in the area. The other aspect I really liked is, over the last 10 years, when we do our due diligence, and we spend around 30 hours doing due diligence on these properties, things like lease review, contract review, tenant interviews, road and traffic analysis, vacancy study, occupancy study, checking things are registered, fire compliance, things like that. But in the last 10 years, when we did the vacancy study, there was only 2 properties that went vacant. and the longest period of vacancy was around 6 months, and the other one was about 3 months. So for me, I've got almost what I call a guaranteed income for a long period of time. If I lose a tenant in a few years' time, for instance, that's fine. I'm gonna get 7/8 of the rent. So the passive income that I've got is only gonna take a smaller hit. Whereas if I buy, say, a larger one-tenanted property and you lose that tenant, I get no income. So this is just a nice way to diversify the rents coming in and basically guarantee that I get that passive income. Funnily enough, the rents on this property were actually undercooked a little bit by 15-20%. So I bought this property at a 6% net yield. However, in the coming years, that's actually gonna jump to close to a 7.5% as we bump the rents up, which I can explain later. But just on the whole, this ticked the boxes. It was good tenants, good location, long leases. Most of the leases on this property are generally 3 to 7 years. So there's a few 3 years ones and a 5-year one in there. So good long leases as well, good tenants, and a developable site. So for me, it just ticked all the boring boxes, and it's gonna give me a nice stable income. Where this property gets very attractive is when we actually have a look at the numbers. Let's break down the numbers a little bit. As I mentioned, we bought this property for 3.175 million, which funnily enough, I actually intentionally overpaid. So in our team at Palise Property, we've got a qualified valuer, and he actually said it's only probably worth around 3.1. However, the reason I paid a premium was because there's about 4 or 5 other buyers, because we knew the agent, willing to buy this property at a higher price. So for me, that is actually security in the future as well. If I've ever had to do a fire sale or sell it on because my circumstances change, I know there's a lot of interest in this property. So for me, paying an extra 75 grand, which in the reality of like a $3 million purchase, is a 2 to 3% more than I should have paid. However, it's like buying a $1 million residential property and spending $1,020,000. Like it should not be a decisive factor, but at least I know I've got a good kind of stock here. The numbers when I bought this property 6 months ago was 191 grand. That's actually up at around $205,000 now, so we can actually increase that, which from a lease rental increase, that's gonna go up to like about 230, 240 just in the coming years, but we'll leave the numbers as is. On this property, however, this is probably the main thing, is I put a large deposit, so loan to value ratio, and this is part of my strategy. So for the low risk nature of it, and we're gonna go that into another spreadsheet, I actually put close to a $1.5 million of my profits from my residential portfolio into this. I'm actually gonna do another property like this, which I'll discuss a little bit later. But on this one, quite a large deposit, and not everyone has to do this, and not everyone's in the same position. Some people might do a 20% deposit or 30% deposit, but I'll show you why I've done this. So from a risk mitigation point of view, interest rates don't actually affect me too much. So we can actually have a look at the cash flow, and instantly, we're at about 121 grand a year passive income just from buying this property. If interest rates go up, so I've stress tested this, interest rates generally have to go up to around 13% before the property starts costing me money. And this is why I consider sometimes commercial is lower risk than residential, because I can weather way more storms. If you go buy a $1 million residential property that costs you 20, 30 grand a year negative, and interest rates go up to 10%, that's $80,000, $90,000 a year negative, so you can't hold many properties. Whereas I could buy 2 or 3 of these and actually be able to weather that storm. Instantly, I've got a 6-figure passive income, 100K plus, which is just unheard of in residential. To do that in residential, you need probably around a 10 to 12 mil portfolio and around 10, 15 years of rental growth and capital growth. So that's a really cool low risk part of this. Yes, I could have actually put less money into this deal and bought a larger property. So some people say that, go, oh Steve, why didn't you leverage more? I could have put say a 30% deposit on and went out and bought a 5 mil property. However, I wouldn't have the passive income now, and the next spreadsheet I'm gonna show you is the real powerful one. The negative with this strategy, even though I'm a really low risk strategy, is I'm missing out on future net wealth because of it. And what I mean by that is if I, instead of had a 5 mil portfolio versus a 3, and the portfolio doubles in the next 10 years from capital growth, that's an extra $2 million of net wealth I'm missing out on. And then in the future, I'd actually have a bigger passive income in 10 years time from a larger portfolio, but I won't have it now. And that's the difference. And this is why this video is really important about assessing what actually makes you happy and what number you actually need to be happy, as opposed to just chasing this long goal for the sake of chasing a big long-term goal. But let's have a look in the next spreadsheet. So this is the one that really blew my hair back. So let's have a look at the numbers. So 3.175 mil, 50% deposit. Let's keep the numbers that we had before, around 6% net yield. I got this on a lease stock loan. We can watch some other videos if you're interested in lease stock loans at a 6.5%. You can generally get interest rates between 6 and 7% for commercial, but I got 6.5%, getting $28,000 of depreciation each year, which is nice. It's a cherry on top, but however, be aware that you might have maintenance and things like that down the track. So I bought this property. So this is quite conservative because I don't have the same numbers before. So you can see it's actually less than 100K, but in reality it's 100K now. Day dot, around 100K income. All this spreadsheet is actually doing is, if I'm not enjoying the passive income now, and I'm not because I'm still working and I still enjoy work, I'm gonna put that cash flow back into the debt. So that 1.5 mil debt that I actually had, if I put that circa 100 grand back into it, you can actually see the debt will actually go down year on year on year. What actually happens is because there's less interest you're paying, the cash flow actually starts going up year on year on year. But this is a really powerful moment. So in year 8, at the end of 7 years, this property is debt-free, no risk at all for me owning the property, and 250 grand a year passive income. So think about that, $250,000 passive income from buying one property that's quite low risk. As I alluded to before, I've actually got about another $1.5 million from selling my residential portfolio that I'm actually gonna put into another $3 to $4 million property. Similar to this, low risk, most likely not gonna be a retail center because I wanna diversify. It'll most likely be a multi-tenanted industrial property in a different state of Australia, so I diversify that way. However, if you double these numbers, you can actually see in 7 years' time, I'm gonna be debt-free on a 6.5 mil-ish property portfolio and $500,000 passive income. I wanna say that again, $500,000 passive income. And I'm not saying this to boast. This is purely just to show you the difference of, to get a $500,000 passive income residential, it is a 20, 30 year plan, and you need probably a 15 to 25 mil portfolio, which 99.9% of investors in Australia can't actually have the servicing to get that. So that's an unachievable goal for most people. This one, however, most people can build a 3, 4, 5 mil portfolio over time. Not everyone's in this position yet, and I did start it with residential, but it just shows you can actually do it in much shorter time frames and actually get something worth living. And that's the point I want to take away from this video. 250 grand a year in passive income changes your life, but not in the way most people assume. Doesn't mean private jets or retiring to a tropical island. For me, it means having the freedom to work on things I care about, travel without watching the clock, and spend real time with the people who matter, like my daughter, partner, and friends. It means I can fly business class when I want, stay in the places that make the trip more enjoyable, and not feel like I have to wait for some far off future to enjoy my life. And the truth is, beyond a certain point, more income doesn't actually change much of your life. Once you cross the threshold where your lifestyle is fully funded and you're doing the things you love, everything else becomes noise. Chasing $1 million in passive income or a $20 million portfolio might sound impressive, but I've learned that it often leads to more complexity, more risk, and more pressure, and more time spending in a job that you don't actually enjoy, not more freedom. If anything, the goalpost just keeps moving. That's why I anchor my strategy to what I call happiness goals, the things that genuinely bring fulfillment. For me, that's travel, being present with my daughter, staying physically active, and working on passion projects. I don't need 50 properties to support that. I just need enough quality income to live deliberately. I've worked with enough clients to know that most people never stop to define what their version of rich actually looks like. They normally set up an arbitrary number, like, I want a 200 grand passive income. And then when you explore a little bit deeper and ask why they want that, they say, oh, I want to be able to travel full time. But you can definitely travel for full time with less than 200K, so why do a job that you hate for an extra 10 years for the sake of something that you could have in 5 years? They follow a plan designed for someone else, and years later wonder why they still feel stuck. The real question is, how much is enough for you? Cheers.